Why Americans stay broke. The average American household earns more than almost any country on earth. More than Germany, more than Japan, more than the UK. So why does it feel like everyone you know is one paycheck away from disaster? Why do doctors making $300,000 a year say they're broke? Why do people with 2 cars, a house, and a good job still have less than $1,000 saved? I'm going to show you the exact system, not a mistake, not bad luck, a system that was built to keep high earners poor. And by the end of this video, you'll be able to spot it in your own life in about 4 minutes flat. Because staying broke in America isn't an accident, it's a business model, and you're the product. Chapter 1, The Illusion of Wealth. Let's start with a question. If I showed you 2 people, person A, $180,000 salary, leased BMW, 4-bedroom house, private school for the kids, 2 vacations a year. Person B, $65,000 salary, 10-year-old Honda, a rented 2-bedroom, no vacations. Who's richer? Almost everyone picks person A. Almost everyone is wrong. Person A is what financial researchers call high income, negative net worth. They look rich. They are on paper poor. Person B, meanwhile, might have $40,000 sitting quietly in an index fund. This is the first trick of the American financial system. It rewards the appearance of wealth, not the possession of it, because appearance is what gets financed. Banks don't lend against your happiness or your savings discipline. They lend against your income. And once you're seen as a good credit risk, you get offered bigger houses, bigger cars, bigger credit lines. The system doesn't ask, can you afford this comfortably? It asks, can you technically make the minimum payment? Those are very different questions. And almost the entire consumer economy is built on the gap between them. This is called lifestyle inflation. But that name undersells it. It's not really inflation. It's a ratchet. Every raise you get isn't extra money. It's an invitation. A slightly nicer apartment becomes available. A slightly newer car feels overdue. Friends are going on a trip, and now you can afford it. Nothing about this is stupidity. It's designed. It's the natural output of an economy where your worth is measured by your visible consumption, not your invisible savings. Chapter 2, The Paycheck Trap. Here's the second piece of the machine. Most Americans are paid in a way that makes saving structurally difficult, even if they want to. Weekly or bi-weekly paychecks feel like income. They're actually a treadmill. The moment the money lands, 5 withdrawals are already lined up: rent, a car payment, a phone bill, minimum credit card payments, and childcare or insurance. What's left over is what economists sometimes call residual income, whatever survives after fixed obligations. For the median American household, that residual is often under 10% of total pay. Sometimes it's negative. Now here's the part that should make you angry. The financial industry knows this residual number is thin, so it built products specifically to sit on top of it. Buy now, pay later checkout options. Overdraft protection that charges $35 for a $4 mistake. Subprime auto loans with 20% plus interest rates for people with damaged credit. Payday loans that can carry annualized rates north of 300%. None of these products exist because people are irrational. They exist because the residual income gap is profitable. Every dollar of stress in your finances is somebody else's revenue line, and the debt itself isn't neutral, it's a subscription you didn't choose. The average American credit card holder carries a balance month to month, and at typical rates near 20% plus. That means a huge chunk of every paycheck isn't going toward things you bought, it's going toward the right to have bought them. You're not paying for the couch. You're paying for the delay. This is why raises rarely fix the problem. If your fixed obligations rise in step with your income, which they usually do, because bigger paychecks qualify you for bigger loans, you can double your salary and still have the same 5 to 10% residual. Chapter 3, The 3 Industries Built on Your Brokenness. Let's name names. 3 industries in America are, structurally, dependent on a large portion of the population staying financially fragile. First, consumer credit. Credit card companies don't make most of their money from people who pay in full. Every month, those customers cost them processing fees and give nothing back. The profitable customer is the revolver, someone who carries a balance. The entire rewards points, cash back, sign-up bonus ecosystem is a recruitment funnel for people who intend to pay in full, but statistically a meaningful share won't. The points are the bait. The interest is the business. Second, the auto industry, specifically financing. New cars depreciate fast, often 20% in the first year alone. But dealers don't primarily make money selling cars anymore. They make money arranging financing, extended warranties, and add-ons. A 72 or 84-month auto loan, increasingly common, quietly resets what affordable means. It's not that people are choosing worse cars. It's that the loan terms stretch to make bigger cars feel like smaller payments, which keeps buyers in debt for the length of a small mortgage on an asset that's worth half as much by the time they're done paying. Third, housing in the way it's marketed to first-time buyers. A mortgage lender calculating what you qualify for isn't calculating what leaves you comfortable. It's calculating the maximum the underwriting model will approve. That's frequently 28 to 36% of gross income going to housing, sometimes more with certain loan products. Qualifying for a payment isn't the same as being able to live well underneath it. The bank's downside if you struggle is limited foreclosure recovers most of their capital. Your downside is your whole financial life. None of this requires villains twirling mustaches. It requires normal companies doing normal profit-maximizing things inside a system where the average person's financial literacy was never seriously taught. Which brings us to the part almost nobody talks about. Chapter 4, the education gap. Most Americans spend 12 to 16 years in formal education and are never taught in any structured way how compound interest works against them in debt and for them in investing. They're never taught what an APR actually compounds into over 5 years. They're never taught the difference between an asset that pays you and a liability that bills you monthly. They're taught trigonometry. They are very rarely taught how a 401k match works, or why not taking it is refusing free money, or how a Roth IRA can compound tax-free for 40 years. This isn't conspiracy, it's closer to institutional neglect. Financial literacy has never been treated as core curriculum the way math or reading is, and the gap left behind isn't filled by nothing. It's filled by financial products marketing departments, which are extremely good at teaching people exactly what serves the product. Get pre-approved, 0% APR for 12 months. Your credit score matters, true statements, taught by parties who profit from what you do with that information. The result is a country full of intelligent, hardworking people who can build a company, write code, or manage a hospital ward, but who were never given the operating manual for their own money. Not because they couldn't understand it, because nobody with a financial interest in their staying broke was ever going to volunteer it for free. Chapter 5, the way out. So here's the actual escape path, not motivational fluff, the mechanical version. 1. Measure residual income, not total income. Take your take-home pay, subtract every fixed, unavoidable obligation, and look at what's actually left. That number, not your salary, is your real financial position. 2. Treat debt interest rate as the decision maker, not the monthly payment. Anything above roughly 7 to 8% interest should be attacked aggressively before extra investing, because you are mathematically unlikely to consistently beat that return elsewhere after taxes and risk. 3. Automate the gap before lifestyle can claim it. The moment a raise arrives, the increase should move automatically into savings or investing before it ever touches your checking account. If you never see it, you can't spend it. 4. Understand that qualifying for a loan is not the same as affording it. Underborrow relative to what you're approved for, on purpose, every time, house, car, everything. None of this is exotic. It's the reverse-engineered version of exactly what keeps the machine running, and simply refusing to feed it is most of the fight. Closing. Staying broke in America was never really about how much people earn. It's about a system finely tuned to convert income into obligation before it can become ownership. The people who escape it aren't smarter or luckier. They're the ones who saw the mechanism early enough to opt out of it. The residual income, the interest rate math, the qualifying versus affording gap. Now you've seen it too. If this changed how you look at your own paycheck, subscribe, because next week I'm breaking down the exact investment order high net worth families use that almost nobody teaches regular people. End card. Subscribe animation. Suggested next